Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Seema Shah of Principal Asset Management writing this: the potential for further equity gains may be somewhat limited from here with valuations so stretched. A soft economic landing is a necessary backdrop to support further gains. Seema joins us now. Seema, good morning. Welcome.
Good morning. Great to be here.
Great to have you. When you talk about stretched valuations, are you talking about the overall market or are you talking about NVIDIA?
I'm talking about NVIDIA.
Okay.
Because if you look across the broad market, actually it doesn't look that stretched. We're really thinking about the pockets. It's difficult at this point, though, to look across and say, right, we need to have a broadening in the rally. But that broadening in the rally can only take place if there's still a sturdy economic backdrop. Now, we are generally quite positive on it, but we are hearing more and more clients actually really worried about the economic backdrop. Real concerns starting to creep in to the point that actually when we think about risks or we're hearing about risks, we're hearing more about what's going to happen with a hard landing than with an acceleration. And that is a very, very clear shift that we've noticed in the past few weeks.
And that's something that a lot of people are talking about. Morgan Stanley came out over the weekend, Mike Wilson, and he said he put there 3 scenarios that really counter this risk. One of them is overheating. Nobody thinks that's really going to happen. One is potential liquidity risk, and he talked about treasury auctions and some of the politics of the moment. And he said that the base case in terms of what could potentially disrupt this is, to your point, that hard landing scenario. How important is what we get on Friday in terms of personal income, personal spending, core PCE to really inform whether that's a more realistic base case?
So it's definitely important because obviously we know the consumer has been the key driver for the US economy. But you said the buzzword before, which is bifurcation. Right, so you've got the really high income households, which are essentially carrying the US economy. You've got the lower income households, which are maybe seeing a couple of strains, but because the job market is still very strong, there's no major job losses, that they can almost continue going, and those higher income households can carry the US economy. It's really, to me, it's about the labour market, because if you start to see those jobless claims increasing, if you start to see it translating to job losses, well, then the lower-income consumers can no longer, or I should say the high-income consumers are no longer able to sustain the U.S. economy.
And we talk a lot about what the landing will look like. We rarely talk about what the liftoff after that landing looks like. So if we're in this environment, we get this soft landing. How important is it that growth isn't anemic, that it can take off again for a more sustained and longer-term rally?
So it is really important, but actually I'm going to say something slightly different. So when I think about the landing, we think that fine, you can get a soft landing up to Q1 and Q2 next year. But to the point that the Fed starts to cut, the people who are waiting on the sidelines to buy a property, and if you don't have job losses, I worry about how does the economy react to that? You could see another takeoff and then another acceleration. So actually, I think, to me, although I know that's not what people are necessarily talking about, although the acceleration is not key at the moment, maybe as you look to 2025, that is a theme that starts to return to the market.
No, I think that's such an excellent point, Seema, because it raises this question, is the Fed going to have the opposite intended fact when they start to cut? That everyone rushes to the market and all of a sudden housing prices go up, and how policy is usually transmission isn't transmission the way it is. So does that mean if the Fed starts cutting, they need to start cutting aggressively in order to make sure that it is not a housing market that takes off like crazy, that there's some incentive for supply to come back in?
I think they just actually be really careful how they cut. I mean, I do believe that they need to have all of the evidence in hand before they start those rate cuts. They need to be very clear that there is a softening in the economy. They need to see that the labour market is maybe not showing clear cracks, but there is a rebalancing taking place. Otherwise, they risk almost disrupting the economy again, and then we've been back to the same place as we were a few years ago in about 12 months of time.
When it comes to the housing market, though, potentially those individuals that maybe they've wanted to upgrade to more space, but they're sitting on a 3% mortgage. What if all those people come into the market and then actually you have so much supply that it dilutes pricing power? Wouldn't that be almost a Goldilocks for the Fed?
It would be, but actually, I think although the supply has increased, the amount of people who are waiting on those sidelines, as you said, have been enjoying those 3% mortgage rates, but scared to go to buy a new property. Once they come back flooding into the market, I actually don't think that the supply is sufficient to stop the housing market from taking off again. So I think that is one thing that the Fed really needs to keep a very close eye on in order to avoid this second wave of inflation, which, look, at the moment there is absolutely really no sign of. But I think it is a risk that the Fed is very aware of, which is one of the reasons why they are so careful about the timing of those cuts.
You talk about history suggests that long Fed pauses are good for stocks. But when you look back at history and in your research, has it always been this concentrated? I mean, I look at Peter Cheer's note today, which is kind of how you started the show. Fragility in a one stock is a stock market. It's all about NVIDIA. Have we ever seen anything like that?
I don't think we've seen anything quite like this in a way that the tech gains are quite fundamental. I mean, there's something fundamentally driving it. I wouldn't compare it to the dot-com. But also when I look across at tech, I think they're somewhat macro-agnostic. I don't think they're necessarily reliant on what's happening in the macro space. I don't think they're necessarily reliant on the Fed space. I think they actually create their own demand. At some point, that party will stop. It doesn't look like it's anytime soon, but at some point it will stop. That, I think, is a very hard part to predict.
So you sound kind of bearish. What are you doing?
If I sound bearish, I don't mean to. I think that we should actually be slightly risk-on, but not as risk-on as we were about 6 months ago. So we do have a slight overweight to equities, but that has been pulled back a little bit because, as I said, we think that the equity gains are quite limited from here when you start to see that slight softening in the economic backdrop, and when there is so much concentration that sentiment is starting to get a little bit impacted, where people are getting a bit worried about how much exposure they have to these very, very high, these high stocks. Within fixed income, we actually think it should be back to neutral. Investment grade is probably the area that you want to be focused on with slightly high quality, but duration doesn't look very attractive to us. At 425, especially as you were talking before about the fiscal deficit, I don't see yields coming back down too far because that term premium is going to keep thinking about the deficit.
So are you just hoovering up French bonds? Because there's extra premium there, I hear.
French bonds really scare me, and the reason is this. So there is a genuine reason I think investors should be concerned about it. The discussions that are going on could really change the deficit narrative over there, fiscal discipline out the window potentially. But also, if we're a US investor, you've been looking at Europe in the last couple of months saying, wow, is this real? Can this really be sustained? This political disaster at the moment, which is starting to unfold, is going to scare investors again. It's going to be like, oh, where are you again? European political basket case once more. And I think that is a concern.
I feel like that just leaves us back with the US, then, Seema. Is that all this is? Is this just American exceptionalism 2.0 when you buy not America just because it's good, but because Europe is scary?
I think the US exceptionalism is very, very key here. There are pockets around the world, so it's not like it's just the US market. But certainly, as an overweight, where are we going to be focused on? It is certainly the US.
That's sort of the reason why, as much as people want to complain about, the auctions and, the deficit, you can't really do that because it's, Europe. Seema Shah, thank you so much for being with us. Seema Shah, Principal Asset Management. Now, I'm so pleased to say, is Tom Michaud, CEO of KBW, a Stifel company. Tom, a lot of people have been raising this issue about whether we're fighting the wrong war and whether maybe some of what the regulators are targeting with banks is counterproductive for the current cycle. Do you think that that's going to be in focus later this week?
Well, I think, first of all, with the stress test, the first thing you're going to see is that the banks are in very, very good shape. Remember, the stress tests were set up to look at an adverse scenario to show the marketplace that they have plenty of capital to withstand that. And we think that the conversation is going to move away from that to individual company analysis quickly, which is actually a really positive statement about how the industry has been continuing to build capital. The other thing is the industry's not only been building capital for the stress test, but the industry's been building capital to get ready for Basel III endgame. So that's been the big story. So I think the first box to check is that the industry's going to come out as being very well capitalized. And then there are going to be individual companies that are pivoting in one direction or another.
So there's a lot to unpack. There's a question about which banks, let's start here, are really strong and resilient, right? I mean, it's one thing to say JP Morgan and Bank of America and Citigroup aren't going to fail. I don't think anyone is saying that they're at risk of any kind of real potential turmoil. It's really the regionals. At what point do we get some confidence there?
So there are 23 banks in this test that's coming on Wednesday. So they start to go down into the super regional category. I think for all 23 banks, the market's going to say they have plenty of capital. I think for the regional banks are still in pretty good shape. except for the ones where there might be more concern around real estate exposure, for example, and you're seeing a downturn in some of their results. But by and large, and again, I think it's very narrow as to where the concern is. I just, in preparation for coming today, I was interested about dividends. I went back and looked at there are 74 banks that are in the Keefe Bank Index or Regional Bank Index. If you look at since the beginning of last year, 5 of them cut or eliminated their dividend. Meanwhile, 54 of them raised their dividends over that period. The industry is actually in really, I think, pretty good shape for the challenges that we've had, and I think that the areas of concern are generally more narrow than you would think. And then remember, last year's bank failure moment was really around a liquidity crisis, and what we realized is that some banks had gotten offsides in terms of their concentrations and their deposits. I don't think that that was a broad-based trend.
Even so, I mean, every now and again you hear of another bank that maybe isn't hedged to interest rates. The latest one was a large bank out of Japan, I think their largest agricultural bank, who was basically positioned for rates coming lower. Obviously, that hasn't happened yet. When you hear these incidents of pockets of stress, do you think that these are still the rare bank that haven't hedged against the current rate environment, or if it's higher for longer, do we hear more of this?
So I think with the focus for this conversation right now being in the U.S., I'll go to our Bank America upgrade, which we did recently. We have earnings models by quarter for net interest income. I think just about all of the 220 banks we follow, nearly all, are going to hit a bottom on a quarterly basis, either last quarter or this quarter. That's the reason why we upgraded Bank America, is the second quarter is the inflection point, and it gets better from here. So it's all a question of timing. There's another point. The 3-month, 5-year yield curve spread is the most important for banks. I know that plenty of attention's on 2-10s. That's not the key for the banks. It's been 62 years since we've seen the length of time for the inversion that we've had. So all things really kind of need to do is get a little bit less bad for these banks to do a little bit better. And I think that pivot is right here, right now. And these banks have a lot of bad news in them. As long as we don't get a hard landing, I think you're going to see a continuing quarterly improvement over the next 4 or 5 quarters. And also, too, there are specific types of banks we like more than others. But this is a great opportunity if you can look longer term, we think.
I know you want to stay in the U.S., but I have to take you to Europe, especially given we're going to get one of the first rounds of French voting on the 30th. You've had the likes of J.P. Morgan really be courted by Macron, saying, come move to Paris in a post-Brexit world. And you've seen other U.S. banks do something similar, really building up operations and talent bases in Paris. If there is political volatility, what happens?
So I think it's really the big picture of what's happening with the economy. One thing I would note is over the last 12 months, banks have been the leading group in Europe. Again, there was so much bad news in these stocks, and really what you need in Europe is you needed some improvement in the rates. Negative interest rates were certainly adversely affecting the banks. Our sense is it all comes down to what the economy is doing. We still think there's upside for the banks because the banks have done a lot to stabilize themselves over the last several years, and many of those stocks still trade at 60% of book value. So we think that the bigger banks are stable in Europe, and it's a question now of what's happening in the economy.
Does the concern we heard last week from the Fed in terms of living wills of some of the U.S. biggest banks finding some shortcomings when it comes to the likes of Bank of America, Citi?
You know, you remember that teacher in college who was always a hard grader who never really gave out the, oh, this is perfect, you're all done, you don't have to do anymore? I will imagine for the rest of my career, every year there will be more work to do on a living will, okay? And if you look at the living wills, J.P. Morgan had work to do. Citigroup had work to do. And really, these living wills are evolving with the risks of the moment. And also, I would say, given last year's bank failures, the FDIC has probably sharpened their pencil on these living wills. But so I would view it as it's a living, breathing thing. I didn't see it. Our view on it is the banks are going to spend more money preparing for them, but that there was nothing devastating or really significant in what we read in the results.
To say, the reason why I started by asking you, are we looking at the wrong risks, is because in the past couple of years, first of all, the risks that I hear about, what profitability opportunities do some of these smaller banks have when they're facing off with the rush of money into private capital? That's a big question at this point.
Oh, there are some tectonic plates that are moving that if you want to take a step back and not look at the snapshot and look at the movie, yes. And really what it comes down to is funding and liquidity and deposits. Banks don't fail because of capital. Banks fail because there's a bank run. And there have been very few of them in the United States. So the capital's fine, but really what's happening in the deposit base? I think the greatest missed opportunity from last year is there's not been FDIC deposit insurance reform because it puts too much pressure on the small banks and it's encouraging market share to move up cap to the banks that have proven that they're too big to fail.
And it also, yeah.
So that's the biggest. And then number two is when it comes to stock selection, the way that regional banks, smaller community banks earn money in the biggest banks is very different. The smaller banks have more real estate and more spread income. They are going to be slower to rebound. The bigger banks Bank America, amongst the biggest banks, has some of the least amount of commercial real estate exposure. These bigger banks have already made the shift away from that. And that's why we are leaning in heavier on these bigger banks for the stock ideas. We think it's going to take a little bit more time for the regional banks to turn.
There might be safety and even profitability in some of the bigger banks. There isn't so much of the classic market making, and this is the other risk that people talk about. Liquidity risk on another level, that they're not going to be able to shepherd this amount of bond auctions into the market and allow the trading to commence with the same kind of stability that it has in the past. Does that keep you up at night?
Now you're talking about the Treasury market?
Yeah, in the Treasury in particular, given the fact that the market has swollen to such a huge part, but it's also the credit market. I hear about this with public credit as well.
Well, what I take out of that is passive investing is at the highest degree of our lifetime and growing more, and in many ways it's changing the investment business. So there are so many of these indices and index-driven funds that so much of that, and it's impacted the liquidity of a lot of the smaller companies. So if you look at a typical mid-cap stock, it may have 35–40% of their shares owned by passive investors, and it's happening in the credit markets as well. So when you get to individual credits, so that's pushing more of the trading into private markets away from some of the public markets. And so I think that is going to have an impact. So the way in which companies raise capital is all still evolving because there's this big private market that's grown a lot in the last 4 or 5 years.
Tom Michaud, awesome to hear from you. Thank you so much for being with us.
Yes, thank you.
Tom Michaud of KBW. Just to get a sense of how to frame the week ahead and the path of rates going forward. Joining us, Stephanie Roth of Wolfe Research, Morgan Stanley's Vishy Tirupattur. Stephanie, I want to start with you. We've been talking about the auctions. We've been talking about concerns about higher rates. But you think that actually rates are expected to go somewhat lower over the next couple of weeks. Why?
Yeah, so we're looking for the 10-year rate to fall towards 4%, and then it could trend again higher when we start talking about the election and concerns around the deficits. But in the next couple weeks, we could start to see just a continuation of the softer economic momentum. We've seen that in the past couple of prints, and that has brought 10-year rates back down to 4.26, which is certainly lower than many folks were expecting. Many folks were expecting rates to get to 5% before they come back down. But we've just seen that softening in economic momentum, partially because there is actually a genuine deceleration in the economy. Also, seasonals tend to put downward pressure on both inflation and growth in the summer months, and we expect that to be the case in the next couple of prints, which will bring certainly growth expectations back down a little bit. And then inflation should continue to miss. So yeah, core PCE should come in something around 0.15% in the next print. We expect that for the next couple prints, which should allow the Fed to be able to cut in September.
And then after that, there could be something of a sell-off, a slight one at that, but still some modulation there from there. Vishy, what about you? Do you agree with that basically the data is cooperating with the bond market, cooperating with the auction schedule to allow yields to continue the decline?
I think the broad contours of what we expected are very much in line with Stephanie on there. I think the economy is clearly showing signs of deceleration, which we had expected, and it's deceleration, but not falling off the cliff. And we also, as Mike talked about, we expect core PCE will not be a big surprise on Friday, and we expect to see month over month 10 basis points in the core PCE numbers. All of that pointing to a deceleration in growth, a deceleration in the pace of inflation, setting the stage for a September cut.
So how much confidence in you have, Vishy? It sounds like a lot, but just gut check me here if it's true that we've seen the peak in yields.
I think in the near term, I think we have fairly confident on the trajectory of the path of inflation over the next, call it, rest of this year, the next 3 to 6 months. We have a pretty high degree of confidence that inflation will continue to decelerate, and we probably have seen the spikes in rates. I mean, the slight difference of view from the other speaker is that we think that we've been in a fairly in a range that we are really at the tight end of the range. So. Tactically, at this point, we are neutral, pending how the debate and the fallout from the debate will turn out. So, but over a longer time frame, our expectation is that rates will be lower. Our 10-year expectation is that the 10-year Treasury by second quarter of next year, we expect to see to 3.75.
Well, disagreements is what makes a market, luckily. Stephanie, first of all, I have to give you immense credit for this wonderful pun, now OER never, which is excellent. So you actually expect some of the OER to come down. Finally, we've been waiting for this forever. The lag that feels like it's never showed up. So you think that will finally show up in June? Why?
Yes, the June print is the time we're actually expecting it. We haven't been calling it for any particular month until this one. So this isn't necessarily a boy who cried wolf situation. So the reasons for this is twofold. One, the seasonals go the other way, very much so in the first half, and then June it flips. So we should have seasonal downward pressure on OER by a number of basis points. And then on top of that, there was a funky surge in the New York region, which contributed about 12 basis points to overall OER, which is about 10 basis points more than normal. So that should also put downward pressure because that's likely to go in reverse. BLS had put out some comments that it was driven by some noise within the region.
So we're talking about the next couple of weeks, the next couple of months, because that's all that we can talk about. Beyond that, it starts to get very difficult to really have any visibility. And it raises this question, like what we were talking about earlier with Seema Shah principle, that if you do get a Fed rate cut, that could potentially reignite inflation, particularly in the housing market. Stephanie, I want to get your thought on that first. Do you believe that based on how much pent-up demand there is and the likelihood of any increase in affordability will unleash a flood of interest?
Yeah, I mean, this time there's an argument to be made that it could actually be disinflationary. That's not necessarily our call. Our base case is that it'll probably be more neutral for housing prices generally than many expect. The reason is because all of a sudden you're going to unleash a lot of supply. So yeah, the demand is still there, but now you're going to get a lot of supply of existing sales because rates are coming down, and now it's a little bit more attractive than certainly it was when mortgage rates were above 7%. So you actually might get a more normalization in the supply-demand imbalance that could actually keep prices somewhat stable.
I mean, this is an argument that we've heard, right? Which is it disinflationary, inflationary, and everyone seems to disagree. And Vishy, I guess that this is a reason why it's hard to even gauge what's the bigger risk right now. Is it a potential reinflation if the Fed cuts, or is it a potential hard landing recession? I don't have a clear answer, and frankly, it seems like every investor who's come on this show has a completely different take on this. So where do we stand on this? I mean, which is the bigger, more compelling risk?
I think there is a whole host of uncertainties ahead of us. So we have a pretty clear path for the next 6 months or so that the shelter inflation that Stephanie was talking about will continue to decelerate. We get to the same answer as Stephanie does, perhaps in a different approach. We look at all the leading indicators in the rent index, the Cleveland Fed's rent index, and there is a clear lag, and that will begin to hit for the next few months. So, I think a lot really depends on what happens after I don't think a Fed cutting in September will unleash enormous amount of supply into the market. We expect to do some supply. So we think that the pace of home price appreciation will slow from about 7% where we are now to end of the year. Our base case is about 2%. It is still positive, home price appreciation, but that pace will slow. But we should not forget that there is a huge range of uncertainty of outcomes of elections and a larger range of uncertainty of the outcomes of the elections. So all of that is very much front and center. So I think there's a lot of noise, and it's tough to decipher signal from noise. But what we do clearly see is over the next 3 to 6 months, this inflation is clearly on a decelerating mode.
And we're going to hear a lot of political noise this week, especially when you have this debate on Thursday. Stephanie, you write in your note, the first year of a Biden versus Trump administration may look more similar than many expect. Why?
So 2 things. People are worried about Trump cutting off immigration, and he will very likely cut off immigration flows, especially humanitarian parole, which is adding about 75,000 per month. The thing is, the labor market might be in much better balance by the time we get to the beginning of next year, that we don't actually need all of those people. That might risk putting upward pressure on the unemployment rate. So it might not actually be as inflationary as many folks expect. And then the second is, of course, on tariffs. And our base case is that the tariffs wouldn't go into effect until late 2025, maybe early 2026. So the inflationary forces of the difference in administrations might actually not pan out next year. Come 2026, of course, if we get tariffs, that would be a dramatic game changer between administrations and for sure. But for the first year, it's actually likely the economy might look fairly similar under both administrations.
The economy might look similar, but the rhetoric will certainly look different. Vishy, how are you looking at the election and how the impact could be for markets? Stephanie brings up 2 good points, immigration and tariffs, and what happens with those we might not actually see till 2026.
Right. So we might not really know what how to think about elections much after that. What I would like to think about really is what are the products within, especially in the fixed income space, that will perform in either case. That puts us in the range of spread products broadly. So by spread products, I mean public credit, private credit, securitized credit, mortgage-backed securities. We see, as long as you take out that the next move by the Fed is not a hike, as long as we are clear about that, in the timing of the arrival of timing of cuts, how many cuts we'll get when they arrive, and the future course of the various policy options probably matter a little bit less to the spread product universe. So that's where we think that the best opportunity lies.
So just real quick, Vishy, what do you think will be the low that we'll see in the next 6 months for the 10-year?
I think we'll get to close to 4%.
So you guys both are on the same page, about 4%. All right, Stephanie Roth of Wolfe Research, Morgan Stanley's Vishy Tirupattur, thank you both so much for being with us.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.